Three financial pillars. This is a really important topic. I think farm management and business management doesn't get enough credit in regards to the overall desire, the fun of being in production agriculture, aquaculture specifically. But I think it really serves us well to be thinking on the lines of really these three financial pillars that we have for you today. We're going to be talking about that profitability, sustainability, and of course, building our equity. So I want to share with you kind of the roadmap of where we want to explore today, these learning objectives. We want to explore those words. And if nothing else, we need to put those words into perspective on what they mean from a financial statement standpoint. And so taking profitability, so how do we measure that? Understanding sustainability, how do we put numbers to it? And building equity, that sounds great, but what does it look like from a financial statement? So we're going to explore these financial statements and really equate them to those three financial pillars. We're going to look into balance sheet. We're going to look into the income statement and look into why cash flow statements are really so important for a business. And we need to move really from taking our accounting system and going that next step. One of the statements I love to make is that we need to make our accounting system do more than just a tax return. And with that mindset, we can really kind of be ready for opportunities and maybe even threats that are facing our business. So to kind of put that in perspective, you might be familiar with a SWOT analysis. And SWOT stands for understanding within the business strengths and weaknesses, and then also opportunities and threats. So the strengths and weaknesses we can measure by really understanding these financial statements of a balance sheet, an income statement, and cash flow. We can understand where our strengths are and where the weaknesses might be in our business. But what about the other part of that SWOT analysis, the opportunities and threats? So I'm going to open this up with kind of, what if an opportunity comes to you in the business? Are you financially ready to take advantage of that opportunity that presents itself? Well, we may not know if we are ready to take advantage of that opportunity or threat because we may not have a current balance sheet. We may not have done a really solid income statement, or we may have questions about cash flow. So with that said, let me put it in a perspective of a board game. Okay, so just coming off the new year, we might have had some time with family and friends to play a board game. And hopefully on the screen, you can see that familiar set of dice and this board that we might have played called Monopoly. I'm going to focus in on that one space on the board that you get to land on, and you get to pick up a card. And that card is the chance card. And the chance card gives you an opportunity of maybe it's going to be something positive, it's going to be something negative, or maybe that card really depends on where you are at in your game. Okay, and let me put that in perspective. All right, so it depends on if you're early in the game or you're later in the game, that card may have consequences as to the impact that it has on you. So think of that as an opportunity in your business. Are you one of those Monopoly players that are really excited about pulling the chance card and reading it? Well, if you didn't know, there are 16 of those particular chance cards in that stack, 16. And I've arranged them. Well, how many of the 16 are going to be clearly a negative outcome because it costs you money? Are there going to be some that are going to be in the positive? Clearly it's a win. But how many of them, based on that stack of 16 cards, really falls into that group called it depends? It depends on where you are in your business. It depends on where you are in the game of Monopoly. Okay, so take a guess how many of those 16 cards fall into the it depends category. Well, the answer is 8 or 50% of those 16 cards really fall into the category of it depends. So if in your business what if 50% of the opportunities that come to you, or 50% of the threats that come to your business fall into the category of it depends? Well, if it depends on you knowing your financial strengths or your weaknesses, you may be able to turn that situation of it depends into a positive, because you know the financial strengths and weaknesses of your business, because you've done a balance sheet, because you have an income statement, and you know your cash flow strategies. Okay, so 50% maybe of the opportunities might be it depends. And I guess for the sake of the Monopoly game, a 25% or 4 of those cards I put into the negative outcome. So regardless of your financial status in the business or in the game, you're going to have to withstand that 25% chance that something negative is going to happen to you. Okay. I will also contend that there are going to be some positive things that happen to you in your business, and with strong financial statements and position, you're going to be able to enjoy and take advantage of those and survive, again, those positive scenarios. So I guess the point of this chance cards is your business ready for opportunities and threats that happen outside of your business that could be an opportunity for your business to grow? Or is it a threat that it comes to your business that your financial strengths have to be able to endure, so that it depends card in the real life can actually result in maybe a positive outcome rather than become a negative outcome in our business of aquaculture and agriculture? Okay, so what does the big picture look like? Well, as I've mentioned already, the financial statements. I want you to kind of take a look at 2 financial statements that we'll focus in on. One is the beginning balance sheet, and I'll circle that there. The January 1st of the beginning of the year, let's look back a little bit. In the production year of 2025, we would have a balance sheet that started at the beginning of 2025. Right now, we're going to be working on our balance sheet for the new year. So every new year, we have this snapshot in time called a balance sheet that we want to complete. And that really matches up nicely with additional financial statements that we bring in, and that's the income statement. What happened with all the income and expenses, and how do we determine profitability? We're going to call that either a profit and loss statement or a income statement. And then another financial statement that has its own specific purposes is going to be the cash flow statement. What are the sources of the money that we're using, and how are we using them in the business? So these are the 3, but we see 4 type of statements that are very important for a farm manager, a business manager, to be aware of and put value on as we take our transactions from our accounting system and move them into financial statements that we can make the most of in our operation. So let's start with the balance sheet. And the balance sheet is something that we use to build equity. It's one of those pillars that we began with that we want to talk about. But equity really boils down to net worth. And net worth is something that we certainly want to measure as a snapshot in time, like, for example, at the beginning of each year. So the uses of the balance sheet are going to be such that it's going to measure the financial health. It's going to help us measure liquidity and solvency. It's going to help us determine values of assets that are on the farm. It's going to be the best communication tool or instrument that we have with our lenders if we need capital to be borrowed in the business. It also tells us how the assets are financed. Okay, so we have an asset. How are we financing it? Is it something that we've paid cash for, or do we have a loan against it? And it also gives us insight into what we have in businesses, the risk, how much risk can the farm or the business bear as we look into the next period of performance. Okay, so let's take a look at what a balance sheet should look like. The balance sheet is broken into what I would call buckets, or we would call 6 buckets, actually. There's a left-hand side that we'll call and a right-hand side. And so on the left-hand side of the balance sheet, we have 3 buckets, and they're time-sensitive buckets. We have certain assets on the left-hand side. All of the left-hand side of the balance sheet are all of our assets, things that have value. Okay? The first bucket is going to be the current farm assets. The second bucket is going to be the intermediate, or the age of that asset, and we'll get into that. And the third bucket on the left-hand side is the long-term farm assets. So 3 buckets on the left-hand side related to our farm assets, but we also have 3 buckets with the same time or time-sensitive stamp on them: current, intermediate, and long-term liabilities on the right-hand side. So we move from assets, now we have liabilities, because sometimes we owe people money. Okay, and so we have bills to pay in the current, or in the current period of time. We also have intermediate liabilities that have a little bit longer period of time that we are able to pay them back. And then we have long-term liabilities that we are making statements of, or we're keeping track of them at the beginning of the year. Again, that snapshot in time, boom, on January 1st of the current year, we have these assets and liabilities. And in the end, we ultimately want to calculate our equity, or what we would also call the net worth. And so this is the framework of a balance sheet. We're going to dive into what that looks like a little bit more. So total assets minus total liabilities is going to give you your owner's equity, or what we would call net worth. And as a business performs over time, we often see that net worth grows as you're in a career, maybe, or you have a family or a business. Your equity or your net worth can grow over time, so that sometime maybe we can retire and live off of our net worth after we exit the building or transition that business to the next generation. So let's take again a look at the asset side. Again, this is the left-hand side. These are the 3 buckets of the assets. The first bucket is the current assets. These are assets that have a useful life of less than a year, or they are in the form of cash, or can be in the form of cash. This is very important to have some current cash assets or liquid assets so that we can use them to pay the bills in the business. Other intermediate assets have a useful life of that 1 to 10 year period. This often is where we would put the equipment that we use in the business. Now, some equipment certainly is going to have a life expectancy or useful life of greater than 10 years. That could be a tank, it could be a pump, it could be a tractor, it could be whatever that equipment line is used on the farm. That asset is going to be in that 1 to 10 year period. Even though it lasts longer than 10 years, we're going to group and list those assets in the intermediate assets. Now, as you can imagine, we're going to have some long-term assets as well. Greater than 10 years, these are going to be things like buildings and land that are going to be longer-term assets on the farm. So additional 3 buckets that we talked about. On the liabilities side of the balance sheet, we have current liabilities. These are either currently due or payable within the year that we need to pay that commitment. We also have intermediate assets, maybe the loan on that tractor or equipment that is used in the business. The loan for that asset that was in intermediate, we put the loan for that liability in the intermediate bucket for liabilities. Same thing for long-term debt or loans. Things that are greater than 10 years, we put in that bucket for long-term liabilities. This allows us in the balance sheet to do more than just develop net worth. It gives us measure of liquidity. And liquidity, I think we loosely use that around businesses, but liquidity by definition is the ability of a farm business to meet its financial obligations. That means to pay the bills, and it means to have family living expenses, taxes, and make those on-time payments that the business needs to make. That's liquidity. But there are two measures of liquidity that we can put our numbers on. And that's where the balance sheet comes into play. We're going to calculate our current ratio and our working capital as a percentage of our gross revenue. So let's look at current ratio first. It's a measure to the extent to which the current farm assets, if sold tomorrow, would pay off the farm's current liabilities. Okay? What do we have liquid today that we could pay off our current liabilities if we needed to with our current assets? The other part of liquidity is the working capital. Working capital is the amount of money that we have available, and we use that as a percentage of the gross revenue so that we can compare different business sizes. So not every farm or farm business is the same size. We have small, medium, and large farms, but working capital as a percentage of gross revenue is a measure of that operations capital or cash availability against its size of the business. So it can be very helpful in helping us determine our measure of liquidity. Another thing that our balance sheet can measure is solvency, and this is a little bit longer term. And this is our solvency is the measure of our ability to meet all our debt needs if we were to sell at a point in time. The solvency of all of our debt, intermediate, including the intermediate and the long-term assets. We would have to sell our assets to resolve our long-term liabilities, and that's a measure of solvency. So debt to asset ratio, another way is a specific measurement, and think of it as the bank's share of your farm business. Okay, so the higher the ratio indicates the greater financial risk, meaning the bank owns more of your business if that ratio is higher, and you might have or would have a lower borrowing capacity if your debt to asset ratio was a higher number. Okay, so let's take a look at, let's put some numbers to it and maybe some color. Okay, so you're driving down a street, you know what to do at a stop signal or a traffic signal. Green is good, yellow is caution, and red means we need to stop and evaluate. In this case, green is strong on these financial numbers. Yellow has a little bit of caution. Okay, so your number is kind of in a cautionary range. But if your measure falls into the red range, it's an indication based on financial standards of farm businesses, that particular category that we measure would indicate some vulnerability for you in the farm. So this scorecard here, this is the first snapshot of this scorecard. As we look at these three pillars of financial statements, you'll see this green, yellow, and red as indicators of, now I know my number. Okay, there's a column there you see, your farm. You calculate your current ratio. You calculate your debt to asset ratio. It gives you a number, but it also gives you an indication of, well, how am I doing? On the very right-hand side of this graphic, you'll see desired trend. Okay, so the very first one, the current ratio, if your current ratio is trending up above 1.3 and moving towards 2, that is a desired trend, moving towards that stronger number. Not every rising number is the correct direction. Remember that percentage of the business that the bank owns? Solvency, the debt to asset ratio, we want that number to be trending lower so that the percentage of your business that the bank owns is smaller, which means less than 30%. You're going to be a stronger number than being in that maybe that cautionary range of 30%, upwards of 60% of the percentage of the bank of your business that the bank owns. Okay, so we're going to see this scorecard in relationship to the other financial statements as we go through this discussion today. Okay, so if you need some help, there's a quick read in a fact sheet that we have at OSU. That fact sheet there, maybe Nicole, if you want to drop that fact sheet into the chat, that would be great. If you could capture that fact sheet. If not, we'll get to that at the end. These slides will make sure that they're available to you. But this is a nice quick read and a resource, an Excel spreadsheet that you can get to begin to fill out your very own balance sheet for the farm. And in summary of the balance sheet, as we finish off this first portion of the financial statements, balance sheet summaries, again, great communication tool. It sets a number, a measurement of financial health and the business valuations. And it's a snapshot in time. We want you to complete a balance sheet at least once per year. Great time of year to be doing it as we've turned the page to the next calendar. You may have your financial records open for tax purposes or preparation, and it's a great time to fill out your balance sheet. The better your data is, the better you can measure the results, and you're going to have a balance sheet for each year as you move forward, and you can then measure your equity growth over time. Okay, so then the balance sheet will equate to our next financial statement, and our next financial statement is going to be the net farm income or the income statement. So how do we build equity in the business? Well, think of the income statement where all the profitability is measured on the income statement. Profits then are funneled and we filter out the expenses, but then the profit eventually then is realized in a growing equity that you have in your business. So think of the beaker or this vessel as your equity, and over time, the profitability from the net income statement will deliver that profitability and you will build equity over time. But we need the income statement to measure the amount of profitability, to filter out the expenses, and to calculate the true net farm income on an income statement. And that's where we will marry these two statements together and how they're integrated into each other. So the reservoir here is the beaker, is the balance sheet, and the income statement then is that funnel or filter that will deliver those profits into the net worth. Now, the very last note on this slide does talk about non-farm income. So non-farm income can also be funneled into the balance sheet as well. So sometimes our businesses are coupled together with our family balance sheet and our family income, and those two things can be married together. But we can also separate and use a farm income statement to really acknowledge the difference between profitability from the business rather than other streams of money, non-farm income supporting the business. We want to make that acknowledgement that we want the farm to stand on its own and know how it's performing outside of other non-farm income coming into it. So in the next area, we're going to calculate farm income. And there are two farm incomes that we will calculate, and they're very similar to each other. Net farm income from operations. This is going to take your profit from a typical year of operations, and this is going to include all the things that you've done throughout the year, all those transactions of farm income, sales, and expenses that you've had. But also note that it's going to capture some non-cash values that change throughout the year that may pertain to your farm business. And to do a really good job and to not sell yourself short with a blurry image of what your farm income might look like, we need to account for non-cash income and expenses. And we'll explain what that is. So that's the net farm income from operations. But then we also have this bottom line number, net farm income, which is a measure of income earned by you as the farm operator from your very own capital, the things that you own, your labor, your management, all the things that you put into the business. And it also includes any sale or purchases of capital, gains or losses of assets that happen, changes that happen throughout the year. And this statement of farm income represents a production year. So whatever your production year might look like, whatever it works for you, it could be a calendar year, it could be for whatever year your production cycle makes most sense. For most farms, that means January 1st through December 31st. A lot of times it aligns with the tax year, the income tax year that we file with the IRS. So let's do some calculations. Let's do some formulas, and this gets a little interesting as far as equations go, but let's look at that very first one. We're going to start with that net farm income from operations. Remember I said adjustments? We're going to take our total adjusted income minus our total adjusted expenses. And all that means is that we're going to take a look at our income, our cash income that we received in cash, plus or minus any adjustments. And I'm going to give some examples of what that means. We're also going to make those same adjustments on the expenses side because we have things that happen that spill over from one year to the next, because we have businesses that have accrual adjustments that we need to make that really put a measurement so we can calculate for a production year the true net farm income from operation. So let's take a look at an example. Let's take a look at this example, and on the left-hand side first, we're going to take a look at the cash income from their chart of accounts, or let's say their IRS Schedule F. In this example, this farm has sales of $145,000, okay, for whatever they sold, aquaculture products, grain, feed, hay, whatever a farm sells, sales from raised items. We also have maybe some income from other sources. In this case, custom hired work, things that we did for other people, just over $2,000. We're a part of a co-op, and there's a distribution of the co-op dividends that come in, just about $1,000 there, and other cash income. So for this example, and we know every farm's numbers are going to look different, just on the left-hand side here, we would see the cash income from the farm. It totals roughly almost $50,000. On the right-hand side of this chart, we begin to look at some adjustments that have to be made because of the beginning and ending balances during that production year. This farm began the year with over $134,000 in crops held for sale, or maybe you had inventory of fish or other products that you had in inventory at the beginning of the year, but at the end of the year, that inventory value or numbers was different. Okay, so it changed from beginning to end. And this is going to be an income adjustment that we have to make and acknowledge for those adjustments on the farm. We also have differences in accounts receivable, things that we are owed. Okay, accounts receivable at the beginning of the year and at the end of the year, because there was an amount of people that owed us money, which is essentially income. And then there were some other adjustments here on distributions of that cooperative. May not be an example that pertains to you, but in the end, we have these beginning and ending balances on the income side that we have to adjust for. And you'll notice that near the bottom, you see that minus $10,000. That minus $10,000 is a summation of all of those differences of the beginning balance and in the ending balance of differences in cash or cash equivalent values that happened throughout the year. The biggest one was we had less inventory on sellable items at the end of the year compared to at the beginning of the year. So that cash was realized in the year, and we have to adjust for that. And we summarized that here just over $10,000 that we have to reduce our farm income. So we adjusted that farm income from $149,000 down to the adjusted $138,000. So this is just the income adjustments. We must do the same thing on the expense side. Very similar on the left-hand side, we have our cash expenses for the production year. Everything that we had as transactions throughout the year, everything that we spent money on in the business, in this example, totaled cash expenses of $76,000. On the right-hand side, we have to make those same adjustments again. And so we have beginning and ending balances for costs. And there are two categories that I want to highlight. And that would be, we have these paid in advance. Whoops, let me go back. Paid in advance. We want to see that area right here? Expenses that we paid in advance and expenses that are due but not yet paid. Think of things from an accrual adjustment standpoint, things that we've prepaid or things that we owe, but we just have not paid the bill on yet. And so these are areas that we have to think about from the farm that we have to make these expense adjustments for. Now, in this example, the net adjustment, row F in this example, was only $175. Okay, not a big deal. The biggest adjustment that businesses overlook often is going to be this economic depreciation. Economic depreciation is a number that's important so that over time we are adjusting our values and we're acknowledging that we have wear and tear on equipment and assets that are being used in the business. Remember that tractor that we have in the business? Remember those tanks and pumps and things that we have on the farm? Even though the cash expense to keep them operation may not be out of pocket, we certainly have a depreciation cost associated with those assets that are wearing out on the farm. And a income statement must account for the depreciation of those particular farm assets that are being used in the business. Okay, so in this case, the biggest expense adjustment is going to be depreciation. So it increases our expenses from $76,000 in cash expenses. We increase it by an accumulation of $13,000 plus a little bit more for our total adjusted farm expenses of almost $90,000 in this example. So let's bring it all together and calculate for our net farm income from operations. We have our net cash farm income, and maybe that looks pretty good. It looks like we would have made $73,086 from a net cash farm income. But in reality, as we look at net farm income from operation and we make those adjustments so that we are accountable for changing inventories and the wear and tear of our assets, we actually have a net farm income from operation of $49,000. Okay, that is how we would calculate net farm income from operation. And over time, we would use that number to measure our success on the farm. Now, the bottom line number here, net farm income, would take into account any other sale of farmland or capital assets on the farm business. In this case, we did not have any of those in the production year. So our net farm income from operation was equal to our net farm income for this particular farm. So in the end, this net farm income does more. It's going to help us measure profitability. Profitability of a farm is the difference between what the value of the goods that you produce from the cost of the resources used in their production. And one of those costs of production is going to be the wear and tear of our assets that we have on the farm. So we can't forget about that. And we have to make those adjustments so that we can get to things that we can measure, like the rate of return on assets and the operating profit margin ratio. And these are the actual measurements that we would then be able to use. The rate of return on an asset can be thought of as the average interest rate being earned because we have assets and your investment into the farm, yours and your creditors. Remember the bank that loaned you money to have that asset on the farm? Well, there's going to be a rate of return on that asset. Operating profit margin ratio shows the operating efficiency of the business. How good am I at converting those expenses into profit on the farm? So let's take a look at, again, that stoplight scenario. The scorecard, once you know your farm number, allows you to measure yourself against a financial standard that all farms, whether they are aquaculture, livestock, row crops, use the same financial scorecard for measuring how well am I doing on profitability. Am I strong? Is there some caution? Or is there an area of vulnerability that I might have? A farm may have several that are in the strong category, but this process of having your financial statements can identify maybe there's some areas in the business that your business is a little vulnerable or has a point of caution. That in and of itself helps you as a farm manager to know what to work on and where you want those desired trends to be moving towards. Okay, so net farm income, we want to make those adjustments. Those are essential, and we want to measure farm income statement that includes net farm income from operation and the bottom line net farm income. Okay, the last and probably the least used financial statement, to be honest, is the cash flow, but it can be very helpful. Thinking of sustainability and how we can sustain our business and having the right cash, honestly, at the right time to make our business most profitable. Cash is king, and a cash flow statement is going to be a summary of how that cash flows in and how that cash flows out of the business for that given period of time. A cash flow statement can be looking back at a certain accounting period, and so that would be a cash flow statement. But sometimes businesses want a projection, and so we would do a cash flow projection for the next year or the next quarter to make some decisions with. So cash flow statements can be on annual, quarterly, or monthly basis, and it can also be used to reconcile beginning and ending cash on hand balances. Okay. Now, it does not include non-cash transactions. So all those things that show up on inventories and adjustments for accrual adjustments, that's not going to show up on a cash flow statement. That's why we have those other financial statements useful to the business. So here's another graphic and really 4 insights as to why it's important for understanding cash flow. So the farm business checking account in the middle, we're going to have certain cash that flows into the checking account. And then we're going to have cash outflows that flow out of that checking account for expenses and debt payment and other expenses like taxes and other things. But the cash flow statement, what was the cash used for? Where did the cash originate? What is the farm's ability to service that debt? Okay, do I have enough cash to make those payments? Okay, is the cash generated enough to cover things like family living expenses? That's important. So those other flows of income may be non-farm in certain farms or off-farm jobs that are important in the cash flow statement. 5 activities that are tracked. This gets a little blah, but there are 5 activities that this will track: operational activities, investing activities, financing, non-farm, and then a reference to the cash on hand. We're going to go through and give examples of these to put it in perspective. Now here's a look at a cash flow statement. Each of those 5 areas are on this sheet, not for you to study, but just look at the 2 columns that have cash in and cash out. And so each of the 5 areas are going to have a net cash flow for each of those operational areas, or investing, financing, and so on. Most people, though, think of a cash flow statement like this. We think of the expense item as a row, and then we think of the month or activity in the month of January, in the month of February, and March. So cash flow projections or statements can look and be shared in a variety of different ways. Again, this is not necessarily for us to study and dissect the numbers, but just some typical views of what a cash flow might look like. Real quickly, operating activities, these are going to be the cash transactions. Examples would be out-of-pocket expenses for all the things that you need to operate your farm. Cash transactions, operation activities. Investing activities. These would be when you purchase capital assets that go on your balance sheet, whether that's an intermediate asset like machinery and equipment, or long-term assets like buildings and land that are important for the farm business. Investing activities. Financing activities. Did you borrow money? How did the money come in? Did you pay off borrowed debt? Examples mainly are loans and paying down those interests that are associated with financing activities. Financing activities are part of cash flows. Non-farm activities, okay? Non-farm cash income and expenditures, family withdrawals, other things that happen from a non-farm standpoint, because most and 98.5% or more of the farms in the U.S. are family operations that have these type of non-farm activities as a part of our businesses. And then we have an acknowledgement of reconciling the cash on hand for those flowing in, cash inflows that exceed the outflow. We're going to have an ending cash on hand that should increase, and vice versa. If our cash outflows exceed our inflows, then we have an acknowledgement that the cash on hand will be decreasing at the end of the year. So in short, cash flows meet the pillar of sustainability. We have to be able to service our debt. We should be able to understand where that money is flowing into and out of the business. And one of the measures of sustainability is going to be the debt coverage ratio, indicating if the business can generate enough income to cover the current interest expenses and all the debt payments associated with intermediate and long-term loans that we have taken out for the business. Borrowing money is important, knowing where that money and ways to minimize our borrowing needs, and really timing of that necessity. Lines of credit and tax planning are all part of that. So lastly, our last look at the scorecard. The scorecard also has measures of strength, caution, and vulnerability when it comes to cash flow, sustainability, and the statements that we can get out of that. So in summary, for the statement of cash flow, again, that cash is king. These statements can be for a period of time retrospective, looking back at a period, or looking forward as a cash flow projection, as well as these 5 areas of activities. Cash flow, although it's the least used, can be one of the most important when it comes to managing the day-to-day operations of a farm business. So where have we been in this session as we wind things down? Again, we wanted to explore the three pillars, equating those three pillars of profitability, sustainability, and equity into what are these financial statements that are essential for businesses to be aware of and acknowledge. We want to move your accounting system towards these financial statements so that we have the ability to know what those opportunities and threats mean to our business and take advantage of those that we can best in our business. I'll leave with you a couple of questions about your farm accounting. Thinking back to the 2025 year, did you have questions about the 2025 farm business not answered by your records? If so, we may need to sharpen our tools in the toolbox when it comes to farm accounting and also our financial statements to help answer some of those questions that we had about our previous year. Or another question I would pose, did the 2025 farm records tell you something you should not ignore in the 2025-6 production year for you? Did it give you an indication that there's something I need to do better or to change or to really take advantage of because that's my strength that I have in my business? I think those two questions you can help identify potentially some things to work on during the 2026 calendar year for the farm business. So I'll leave this with our overarching website that we have for farm management resources at Ohio State University Extension, farmoffice.osu.edu, and my contact information that I am so happy to leave you with, that you may ask questions here or as follow-ups that you may have as you work in the area of farm management with your business.